Hi guys. Today I'm about to talk about asset bubbles, and I'll just get straight to it. Asset bubbles exist when prices in some sectors increase over time and trade for higher than fundamental economic and fiscal theory would suggest. The following article will mention two asset bubbles of which my friends and I would have been encouraged if the tech bubble didn't burst. The tech bubble is formally named the dot-com bubble, and it took place in the 1990s. Until 1995, when investor confidence began to shake. This era was characterized by a quick rise in availability of technology, stock, and equity valuations in the form of internet based companies. Capital markets began to throw money at the sector, and startups were racing to get big fast. The result of that kind of misdirected motivation led to technical responsibilities taking a back seat while fortunes were being spent on marketing. Budgets were not astute, and in my opinion, a thoroughly planned budget is recognized as a differentiating factor that is better than spending on marketing alone in the long run. What is tricky is that those tech companies could only show invested projections of long run operations. The tech bubble burst of 2001 due to market overconfidence. While it was due to market overconfidence, for example, companies that had yet to generate revenue and profit went to market with initial marketing operations that projected stocks tripling in a matter of weeks. More recently, the housing bubble in the United States, which led to a global recession around 2009. Yup, a question that probably propagated the housing bubble is how might a sudden increase in people's expectations of future real estate prices affect interest rates? Well, interest rates would rise. This means that the currency would be stronger, and a sudden increase in people's expectations of future real estate prices raises the return on real estate relative to bonds, being that bonds are a fixed instrument that represents a loan from an investor to a borrower, and they can be substituted for foreign currency. Mentioning bonds is important because they're substitutable for um, real estate due to their liquidity against an illiquid real estate market. But then real estate has better advantages like property appreciation. Increased interest rates and returns on real estate yield more capital inflow at maturity than would be bonds. In this case, the demand for bonds falls as investors put their money in the overconfident real estate market, of which, of course, spelled a bursting asset bubble. The collapse of asset bubbles wipes out the net worth of investors and causes businesses to fail, potentially leading to widespread widespread panic in other parts of the economy and thus a recession. I mean, it's quite a topic, and if you guys especially engage with me, if you guys want like differing answers or have questions about asset bubbles, just let me know, put them in the comment section. Yeah, subscribe. Yeah.